Let me begin with a straightforward question. If becoming a millionaire did not require a high-paying job, speculative trading, cryptocurrency luck, or exceptional intelligence, would you take that claim seriously? Most people do not, and that skepticism is one of the primary reasons long-term wealth remains uncommon. In reality, the process that creates sustainable wealth is rarely dramatic. It is typically slow, structured, and uneventful, especially in its early stages. It does not generate attention, headlines, or viral moments. In fact, it often looks unimpressive for many years. This video explains what I refer to as the silent compounding rule and how a modest, consistent investment of $5 per day, earning an average annual return of 8%, can realistically grow into $1 million over time. This is not a motivational framework. It is not a promise of quick results. It is a mathematical explanation supported by historical data, behavioral finance principles, and long-term market performance. Once you understand this process clearly, financial decisions stop feeling confusing and start becoming systematic. A common misconception about wealth is that income is the primary determinant of financial success. While income matters, it is not the deciding factor. Many high-income earners struggle financially, while moderate earners quietly build significant net worth. The difference is not intelligence or opportunity, it is consistency over time. Modern financial culture emphasizes immediacy. Investors are encouraged to pursue rapid gains, short-term trades, and high-risk opportunities. These approaches appear attractive because they promise speed. However, speed and sustainability rarely coexist in wealth creation. Wealth accumulation is driven by time applied consistently, not intensity applied briefly. Compounding, by its nature, is underwhelming in the beginning. During the early years, progress appears minimal. Account balances increase slowly, and returns are barely noticeable. This creates the illusion that nothing meaningful is happening. That illusion causes most people to stop. Compounding is simply the process by which earnings generate additional earnings. Your investment produces returns, and those returns themselves begin to earn returns. Over time, growth accelerates because each cycle builds on a larger base. However, this acceleration does not occur immediately. In the early stages, most of the portfolio's value comes from direct contributions rather than investment growth. This phase can last many years, and it tests patience more than knowledge. Now let us examine the contribution itself. $5 per day equals approximately $150 per month, or roughly $1,800 per year. In isolation, that amount seems insignificant. It is lower than many discretionary expenses that occur without conscious thought. The significance does not lie in the size of the contribution, it lies in its consistency. When the same amount is invested regularly without attempting to predict market movements or react emotionally, the outcome changes substantially over long periods. The assumed annual return of 8% is not speculative. Historically, diversified equity markets have produced long-term average returns within a range of 7 to 10%. Individual years vary, and volatility is unavoidable, but over decades, disciplined investors have generally experienced positive real growth. This is not a guarantee, and it is not financial advice. It is an observation based on historical performance. Importantly, compounding does not reward short-term thinking. During the first 5 to 10 years, portfolio growth remains modest. Contributions dominate returns, and the compounding effect is present but limited. Many investors interpret this phase as failure. In reality, it is the necessary foundation. Before continuing, if you value structured, long-term financial thinking rather than speculation, subscribe to Alex Builds Capital, like this video, and comment "compound" so this content reaches the right audience. In the next section, we will examine the timeline in detail because misunderstanding how growth unfolds over time is where most people lose confidence and exit prematurely. To understand why compounding works, it is essential to understand how investment growth actually unfolds over time.
One of the most damaging misconceptions in investing is the belief that progress should be steady and evenly distributed. In reality, compounding is uneven by design. It progresses slowly at first, then accelerates later, often dramatically. Let us walk through this process using realistic assumptions. The scenario is simple. $5 invested every day, approximately $150 per month, or roughly $1,800 per year. The assumed average annual return is 8%, reflecting long-term historical market behavior rather than short-term performance. After 5 years, the total amount invested is roughly $9,000. At this stage, the portfolio value may be only slightly higher, perhaps $11,000 or $12,000, depending on market conditions. This phase rarely feels rewarding. The growth appears minimal, and returns do not yet justify the effort in the minds of many investors. As a result, this is one of the most common exit points. After 10 years, total contributions reach approximately $18,000. The portfolio may now be worth around $30,000. While this represents meaningful progress, it still doesn't feel transformative. For many, this reinforces the false conclusion that compounding is ineffective. What is not yet obvious is that the structure is still forming. By year 20, the picture begins to change. Total contributions may remain under $40,000, yet the portfolio can approach or exceed $100,000. At this point, investment returns begin to become more visible role. The portfolio is no longer driven primarily by new contributions. It is increasingly driven by growth on the existing balance. This is the transition phase where compounding starts to matter. Unfortunately, many investors do not reach this stage. They stop during earlier periods when progress appears too slow to justify continued commitment. From years 20 to years 30, the compounding effect becomes significantly more powerful. Annual portfolio growth may begin to exceed the amount being contributed each year. This is a critical shift. The investor has not increased contributions. The strategy has not changed. Time is the only variable that has accumulated. By year 30, total contributions may still be under $60,000, yet the portfolio can approach $500,000. At this stage, the majority of the portfolio's value is the result of compounding rather than direct investment. This outcome often surprises people because it contradicts intuitive expectations. The largest gains do not occur early, when effort feels highest. They occur later, when consistency has already been established.
This leads to an important insight. Quitting early does not simply slow progress, it eliminates the most productive years entirely. The final decade is often where compounding reaches its full potential. From years 30 to 40, portfolio growth can exceed the total invested during the first 10 or even 20 years combined. By year 40, under the same assumptions, the portfolio can cross $1 million, not because of extraordinary risk-taking or aggressive strategy, but because time allowed compounding to complete its work. This is why short-term evaluation is misleading. Compounding is not designed to reward early impatience. It is designed to reward sustained discipline. Another important detail is that the contribution amount becomes less significant over time. In later years, daily investments represent a small fraction of total portfolio growth. Returns generate returns at a scale that contributions alone could never achieve. This explains why starting early often matters more than investing larger amounts later. Time has a multiplicative effect that contribution size alone cannot replicate. Before continuing, if this explanation is helping clarify how long-term investing actually works, like the video, subscribe to Alex Builds Capital, and comment "Discipline" to support educational finance content. In the final part, we will focus on real-world behavior. We will examine why most people fail to capture these results, how emotional decision-making interrupts compounding, and what disciplined investors do differently over long periods of uncertainty. At this stage, the difference between success and failure is no longer strategy, it is behavior.
Most long-term investment plans fail not because the math is incorrect, but because human behavior interrupts the process. Compounding requires allowing time to pass without interference, and that is psychologically difficult for most people. Market declines, negative headlines, and economic uncertainty create pressure to act. During these periods, many investors pause contributions, sell holdings, or abandon their plan entirely. These decisions often feel rational in the moment, but they are usually made at the worst possible time. Historically, markets have experienced wars, recessions, inflationary periods, financial crises, and technological disruption. Despite these events, diversified equity markets have continued to recover and grow over long periods. This pattern is not guaranteed, but it is well documented. The investors who benefit from compounding are not those who predict events accurately. They are those who remain invested through uncertainty. This is why compounding rewards behavior rather than intelligence. Disciplined investors automate contributions, reduce unnecessary decision-making, and focus on long-term objectives rather than short-term outcomes. They accept volatility as a cost of participation rather than a signal to exit. In contrast, most people undermine compounding by stopping contributions, reacting emotionally to temporary declines, or attempting to restart later. These interruptions are costly because they often occur just before the most productive phase of growth. The final years of compounding matter disproportionately. The last decade can produce more wealth than the first several decades combined. When investors exit early, they eliminate the most valuable portion of the process. This is why time is frequently more important than contribution size. A modest amount invested consistently for decades can outperform a larger amount invested inconsistently or for a shorter period. It is also important to clarify what this approach is not. This is not a method for rapid wealth accumulation. It does not promise immediate results, and it does not eliminate risk. Instead, it reduces reliance on speculation and increases the probability of favorable long-term outcomes. For many people, the greatest benefit of this strategy is not the final portfolio value, but the reduction of financial stress. Predictable, automated investing allows decisions to be made calmly rather than reactively. Trust in this process is supported by history, not optimism. Markets fluctuate, but disciplined participation over long periods has historically been rewarded more consistently than short-term speculation. This is not personalized financial advice. Individual circumstances differ, and risk tolerance varies. However, the principles of consistency, diversification, and time are foundational to long-term investing. Ultimately, the most important decision is starting. The second most important decision is continuing. No investment plan succeeds without action, and no compounding strategy works if it is abandoned prematurely. At this moment, the choice is simple. Continue observing without participation or allow time to begin working in your favor. If this video provided clarity rather than noise, like it so more people can access structured financial education. Subscribe to Alex Builds Capital if you value long-term, evidence-based investing, and comment "I'm starting" to signal commitment to a disciplined approach. Compounding does not respond to intention, it responds to action. And quiet wealth is built by those who begin early, remain consistent, and allow time to do the work.